Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, U.S. stock futures off session highs this morning as ADP employment data show hiring decelerated to the slowest pace in 2 years. Private sector payrolls increased by just 37,000 last month, lower than all estimates in a Bloomberg survey of economists. That marked the second month in a row where the figures fell below expectations. The president was quick to react on social media, saying the Federal Reserve needs to lower interest rates, quote, now.
Plus, President Trump also saying it is, quote, extremely hard to make a deal with his Chinese counterpart, Xi Jinping, at a time when the White House has been suggesting that the two leaders could talk this week amid rising trade tensions. The commentary comes after the president signed an order raising steel and aluminum tariffs to 50%. From 25%. That's effective today, and the move is seen as increasing trade tensions ahead of a July 9th deadline for negotiations with trading partners.
And Nvidia regaining its title as the world's most valuable company. Shares have staged a more than $1 trillion rebound in 2 months. Investors are betting that the rally has more room to run. The stock has rallied more than 45% since an April low, pushing Nvidia's market value to $3.4 trillion. That beats out its big tech peers in the space like Apple and Microsoft, which is now the world's second largest company by market value. Earnings from the chip giant last week easing investor concerns over the sale of chips to China, as well as the outlook for artificial intelligence spending.
U.S. stock futures off their highs this morning amid the latest ADP payrolls data showing private employers added just 37,000 jobs in May. That is below economists' expectations and the lowest pace of hiring since, get this, March of 2023. President Trump took to Truth Social shortly after the data crossed, calling on Fed Chair Jerome Powell to cut interest rates. And as we were taking a look through some of the key points within this report, number one, we mentioned the increase of 37,000 jobs in May. Annual pay was up 4.5%. But get this, pace of hiring in May, lowest level since March of 2023, as we mentioned, and the April revision as well. That was moved lower from 62,000 to 60,000. However, looking across some of the changes by industry sector, goods producing in aggregate, you saw that move lower by about 2,000 jobs total. And then also looking through where we did see jobs added, service providing, that actually added in here 36,000 jobs. So there's really a lot to continue to keep in mind. Of course, this a precursor in some senses to the BLS report that comes out, monthly jobs report that will come out on Friday.
But as you allude to, Brad, there is a question about the kind of tenuous relationship between ADP data and that jobs report, which is considered the hard data that the Federal Reserve is actually going to look at. Perhaps given the fact that this is in part not data that the Federal Reserve is going to hyper-focus on is why we're not seeing a huge reaction when it comes to the stock market futures, at least at the moment. We are seeing a reaction, though, in the bond market. You were taking a look at your screen there. Yields are lower. Treasuries are catching a bit of a bid, but it's fascinating to see that futures haven't crashed off the back of this ADP print, given what a huge miss it was, coming in at 37,000. The estimate was 114,000. So from triple digits to low double digits. We're also seeing the dollar weaken. And this is something that I continue to get negative feedback for bringing up. But the reason I focus on the dollar weakening is because that is going to put a cap on how much we can see the S&P 500 rally going forward here. If you continue to see the dollar move to the downside, U.S. stocks can only rally so much. That distinct relationship is very critical for investors to keep in mind.
You know, there's another nod here too. If not for seasonality, especially within some of the leisure and hospitality hiring that took place, 38,000 jobs were added in that specific service providing space, which was the largest addition by sector here. If not for some of that seasonality, we could have seen a far worse print than we got here this morning.
I also thought it was interesting that mid-sized companies were the biggest gainer as well. We saw small and bigger companies also being laggards there. And you can tune into Wealth Brad's show at 11 a.m. Eastern Time for a conversation with ADP's chief economist, Neil Richardson. They'll be breaking down more of those numbers. President Trump wrote that it's been extremely hard to make a deal with his Chinese counterpart Xi Jinping in a post on Truth Social Wednesday. according to members of the Trump administration. The two leaders will likely meet this week. Those potential talks coming as 50% tariffs on steel and aluminum went into effect Wednesday. We got Terry Haynes, Pangea Policy Founder, here with us to discuss all of this and more. Terry, it's great to speak with you here. Not only do we have the implementation of these tariffs, the president calling for increased rate cuts, we also have the tax bill that is still underway here in Congress. What would you say is the single biggest headwind to the tax bill right now?
I'm not sure there is one, to be honest. Probably the headwind in terms of getting it finished in the Senate is exactly when the debt ceiling needs to happen. The president very much wants to have this done by July 4th for a variety of reasons, and you've mentioned one of them already today. What they're looking for is ideally a kind of a three-part boost to the economy that comes from the tax bill being done, more trade deals being announced, and decisions on reciprocal tariffs, all of which come around the first week of July 4, July 9. So they're looking at a big boost there. Beyond that, though, I think it's probably full speed ahead in Washington. And since the House and the Senate agree on the fundamentals of this legislation, they've got to spend a few weeks dealing with details, and they're probably done.
They agree on fundamentals, but it's becoming more clear that there are some parts of the bill that members in the House may not have even read, and saying that they would have voted differently had they had known about certain clauses. Now, is that likely to be an earth-shaking type of acknowledgement? Maybe not, but what is the likelihood that we see a bill get sent back to the House here?
Well, that's all. I will tell you that's largely CYA on the part of members. That's a very highly technical legal term, CYA, as you know. And but members have to do it. So there they are. And but I think what's going to end up happening here, and I think the markets are slow to understand this, even if it's bubbling up in Washington, is that the Senate bill is going to be the final bill. When the Senate finishes this thing, they're going to do what in Washington slang is called jamming the House. In other words, basically just saying, look, here it is. We're all done now. There's not going to be any more negotiation. You guys are going to have to take it or leave it. And at that point, Trump's going to have to put the hammer down on the few recalcitrants in the House and urge them to be done with this. I think the House leadership certainly is anticipating that, despite the fact that they profess otherwise in public.
I have to ask you about perhaps a whisper member of Congress, at least an attempted one here, from Elon Musk, continuing to push back from outside of his role in Doge here, calling the tax bill and the spending that it would require an abomination in a post on X. Does he have political power at this moment in time to influence legislation like this?
Very little to none, I think, and that's probably part of the peak in Musk's side. Musk was done as a political force, spent as a political force, largely about 2 months ago. This is the point where everybody first became aware that Musk's time was drawing to a close. Secondly, and I thought more importantly, although people didn't really pick up on this, he'd gotten schooled very gently by Lindsey Graham, the Senate budget chair, about how gosh, Elon, we'll take all your great suggestions and you bring them forward and have Trump bring them forward, and we'll decide what the cuts are going to be. Musk professed to be happy with that at that point, but at this point now wants to complain that there's not enough spending cuts. Well, that's fair, and that's probably a bid to get back in the market's good graces for Musk more than anything else. But for months now, what you have is members kind of giving lip service to the Doge idea and telling everybody how wonderful Musk is, because there's a constituency that Musk has. But at the same time, Congress is going to make the decisions on cuts, not Musk. So fundamentally, Musk has been cut out.
Terry, while we have you here, we do know that we were supposed to, or at least the White House said that they were making plans to speak with China by the end of this week. Now we're hearing from President Trump that it's going to be extremely hard to make a deal with China. I mean, just make sense of it for us, Terry, to the extent that we can here. What is the likelihood that we actually see a deal prior to the deadline mid-July?
I don't think you see a firm deal with China for quite a while, certainly well after July, if anything, for a couple of reasons. One, I think what the United States wants to do, what it is prioritizing, is getting both allies and major unaligneds, whether it be Saudi in the Middle East or whether it be India, for example, on side with interlocking, interdependent trade deals as part of alliances, frankly, to kind of ring fence China. Firstly, so I think the United States priorities are clear. Secondly, where the president is right now is trying to iron out details on this pause that they had negotiated with China that apparently are going south. China has a very long track record of kind of pretending to agree on things and then pulling the chain on details. Yeah. It's what's happening here. So you've got that, and I do think also Trump is trying to send the message that he's dealing with China, not from a position of trying to Bigfoot China, but from a position of respect and equals. And I looked at that tweet about being tough, frankly, as a bid to give China some respect that it says it wants.
Okay, so Terry, help me put a bow on all of these headlines we're getting in this morning. Obviously, the potential weakness playing out in the labor market with the ADP print, the implementation of those 50% steel and aluminum tariffs, and then the tax bill here as well. What is the single biggest thing that investors need to keep their eye on when it comes to any risks to this market that could come from policy in Washington?
Well, the fundamental risk is that the tax bill doesn't get done, right? I mean, everybody's pricing that in and assuming it's going to get done. But if for some reason a spanner gets thrown in the works, then that's the biggest problem, making it look like it might not happen after all. Not only because that might imperil the tax deal, but it might imperil the ability of the Congress to actually extend or suspend the debt ceiling. So, that's hanging in the balance more than I think people understand. Secondly, the relatively weak numbers and the other things that are going to happen this week. You got manufacturing, you got hiring, you got the beige book, you got the trade deficit coming up. That's going to feed into the Trump narrative for growth, frankly. So that will probably help turbocharge the bill. And on the steel tariffs, for example, the steel tariffs aren't going away, and the reason why they're not is that's part of the defense industrial base. And what markets ought to be doing is looking for more opportunity where the defense industrial base is going to get protected and extended government protection. And there's a lot of those across the board, but defense industrial base is something that has been allowed to wither away, and Trump is determined to bring it back.
Multiple minutes into this conversation, we haven't even really done a deep dive on the Fed at all, Terry, and we didn't really need to, though. We'll have some Fed speak later on this morning, we do know. Terry, thanks so much for taking the time.
Pleasure. Thank you.
Nvidia reclaimed its title as the world's most valuable company on Tuesday from fellow Magnificent Seven, Microsoft. And shares of the chipmaker rose roughly 3% during the trading day, boosting the company's market cap to $3.45 trillion. Joining us now to discuss this milestone and reachieving this milestone, what it means for the tech trade, we've got John Belton, who is the Gabelli Fund's portfolio manager here. John, good to have you here with us this morning, and thanks for taking the time. Just the significance of Nvidia once again being the most valuable publicly traded company here.
Yeah, I'm not sure I read too far into that. That's not really my part of my framework, but I do think very clearly the AI adoption cycle, AI usage, and on a related note, the AI investment cycle clearly remains in a very strong phase. I think we are seeing serious inflection in adoption of major AI services, and along with that comes the need for more AI infrastructure. So I think a company like Nvidia, a company like Microsoft, those are stocks that had lagged for most of the last, call it 6 months. They were probably due for a rebound given the fundamentals behind the AI industry remain so strong.
So if the AI industry remains strong, how do we think about who the potential tech winners and losers of that might be? Because before, when tech has been disruptive, it's been to an industry like retail, with the e-commerce, for example. But now the AI tech could be disruptive to the tech companies who may not all be winners here. How are you thinking about that?
Right. I mean, I think there's very broadly three types of companies that are participating in this industry today. And this is a very rapidly evolving industry, but you have chip companies, semiconductor companies, server companies, the companies that are providing the computing infrastructure on one layer. Then you have companies that are coming together to provide the physical infrastructure, so the data centers that are housing the computing infrastructure. And then at the top, you have companies that are building applications and end user facing services that are making use of all the technology. So I think right now what's become very clear is the appetite for AI compute and AI infrastructure is extremely strong. And I think that will continue for at least the next couple of years. What's a little bit less clear is at the application layer, who are the winners and losers going to be? What are the new use cases going to be? And I think beyond the early use cases of chatbots and digital media and cloud infrastructure services, there's a few exciting potential newer use cases like agentic software,
right,
autonomous driving,
yeah,
some use cases in healthcare, but that's going to take longer to play out.
Yeah, since you bring up the application layer, it makes me think about Amazon and their approach with Bedrock to offering a significant amount of options to customers as opposed to really hyper betting on one specific model the way Microsoft has with OpenAI. How do you rate Amazon's strategy in the AI race?
Well, I think first and foremost, Amazon's doing a lot with AI to bolster their core e-commerce business. They're doing more with offering generative AI to their advertisers to create ads that can be shown on their platform. They're doing more with using AI to place the right products in front of the right people. And then they're starting to use more AI in their fulfillment centers, introduce more robotics and do more with automation, which is helping their margins. They're also using it clearly, as you referenced, on the AWS side of their business as sort of an infrastructure provider to third parties. So I think they have a business that lends itself very well to AI naturally. In terms of building their own software applications, I think one of the beauties of the cloud infrastructure model is you can let specialists, third-party specialists, build those on your platform and participate in those economics as well. So that's more where I see things progressing for Amazon, specifically when it comes to building AI software applications.
John, really amazing overview. Thank you so much for joining us this morning. Appreciate it.
Thank you.
We're going to have all your markets action ahead here on Yahoo Finance. Stay tuned. You're watching Morning Brief.
Now time for some of today's trending tickers. We are watching CrowdStrike, Wells Fargo, and Airbus. First up, CrowdStrike issuing a weaker than expected revenue forecast for the current quarter. Still, the cybersecurity firm topped expectations in the first quarter, with revenue up 20% from a year earlier. The company also allocating $1 billion for share buyback shares. Moving lower here pre-market, though, after the announcement, and as we're taking a look at shares, they are in retreat right now by about 7.8, nearly 8% as of this point in time. One of the things that actually stuck out to me from what they were talking about on the call with regard to this most recent quarter, trying to find my note here, but anyway, one of the things with CrowdStrike, of course, is trying to make sure that even within the deal cycles that they're moving through right now, that the guidance is still favorable. And one of the things within that guidance, total revenue expected to be between about $1.14 billion and $1.15 billion, which would actually show 19% year-over-year growth here.
Yeah, and it's really interesting taking a look at Wall Street reaction this morning. We're actually seeing a slew of price target upgrades. Having said that, though, Bank of America did downgrade the stock to neutral from buy, citing that the company does have positive fundamentals, but the valuation leaves only limited upside, and they believe growth is going to continue to decelerate over the next couple of years. So that, of course, is something to monitor when you think about earnings growth going forward here. Again, we also have another price target hike from Evercore, but downgrading the stock to inline from outperform, again, citing the valuation concerns going forward there. Well, next up, let's talk about Wells Fargo's asset cap being removed by federal regulators after 7 years, allowing the bank to grow its balance sheet, gather deposits, increase loans, and expand its Wall Street businesses. The Federal Reserve did impose a $1.9 $1.95 trillion asset cap on the bank in 2018 following its fake accounts scandal. You may remember, folks, this was when there were very aggressive sales goals at the company, and then we saw, unfortunately, some folks on the team, several folks on the team creating accounts that were not authorized by users. Wells Fargo getting a huge slap on the wrist with the first ever asset cap put on a bank in history here by the Federal Reserve, and now a removal of that cap, which will allow Wells Fargo to be much more competitive against other banks.
Yeah, always interesting to hear about banks covering other banks, but Cindy, analysts at least are trying to, and they are reasserting that much of this in the lifting of this asset cap was really already priced into the stock, even though we are seeing shares react in kind, moving higher by about 2.5%, as we saw on screen a moment ago. Finally here, let's talk Airbus. Airbus reportedly in talks with China to deliver hundreds of jets. According to Bloomberg, the order could range between 200 and 500 aircraft and could come as soon as next month when European leaders visit Beijing. This is major, especially as the two major large plane manufacturers have drawn the attention of China, either amid geopolitical spat in the U.S. and China's case there. Of course, Boeing, the major aviation manufacturer here stateside, but then additionally thinking through Airbus and all of this going into what is expected to be a massive type of period for the Paris Air Show. That's happening in just a couple weeks. So we could see even more country-based deals or even airline-based deals get announced over that span.
This is part of the issue of the tariff policy, that you start to see a global reordering of power where Europe and China are now potentially working together here. Let's talk about shares of HPE moving higher pre-market after reporting its results for the latest quarter. HP narrowing its guidance range for the full year, saying it expects a 4-cent per share hit due to tariffs and revenue growth between 7 and 9%. I want to bring in Woo Jin Ho. He's Bloomberg Intelligence's senior technology analyst. It's great to have you on this morning. Thank you for being here. Talk to me about your reaction to these results.
Yeah, thanks for having me on. Really positive results. I mean, a couple of things happened. AI is doing a little bit better than people had anticipated. So that drove a little bit of upside in the quarter. But more importantly, some of the operational issues that hit them in the first and second quarters, they're starting to clean that up. So some of the margin concerns that heading into the print, that was alleviated with the commentary on the call as well as the outlook.
And so thinking through HPE, is this for investors out there that are trying to figure out whether or not they need to add it to their portfolio? At this juncture, is it a strong addition to the portfolio?
Well, we don't make recommendations here at Bloomberg Intelligence. There's a couple of things that I can add. If you think about the enterprise IT play as well as the AI enterprise play, there are only a couple of names that you can from a U.S. investor base that investors can look at. It's Dell, Supermicro, and HPE. I do think that HPE as well as Dell have long-term positive fundamentals when AI goes from the cloud side to more of the enterprise side. So there is a long-term tailwind. It's just a little bit early to recognize that, but HPE is very well positioned for that over the long term.
Can you talk a little bit more about how you are modeling out the impact of tariff policy that continues to obviously develop and change for a name like this?
Yeah, so we do have, just to put a little bit of plug here, we do have a BI tariff matrix. It's actually multi-vector. HPE's tariff exposure is not as large as some people have feared. A couple of reasons is that they make a lot of their boxes or assemble a lot of their boxes out of Mexico. So that is going to be covered by the USMCA. So even if July 9th does come back in and reciprocal tariffs do return, they will largely be exempt from tariffs. Now, there's still some reciprocal tariff risk for on the HPE side for some of their products that are manufactured out of Vietnam or Southeast Asia. But that being said, if there is going to be a drag on gross margin, it's going to be mainly on the gross margin side. Oddly, the aluminum tariffs is going to hit the boxes that cover it, but that's where the drag is primarily coming from.
Well, Jin, how much of an Elliott management overhang is there on this name right now? We know that they had already amassed about a $1.5 billion stake, could be worth more at this juncture.
Yeah, if anything, it's going to be more pressure on the management team than anything else. Is there an overhang? It's odd, and maybe the timing is more coincidental. They did announce an acceleration of some of their operational or cost cutting actions that was announced last quarter, and there's going to be another round of cost actions and operational streamlining in the probably announced in the October quarter as well. So, they're trying to make some actions or put in some actions in place to help alleviate some of, I guess, what Elliott is asking for. But at the end of the day, I almost get a sense that they want to get a management change here.
Woo Jin, thanks so much for taking the time here with us this morning.
My pleasure.
And stay tuned to Yahoo Finance. We'll be sitting down with HPE CEO Antonio Neri in the 3 p.m. hour. We've got all your markets action ahead. Stay tuned. You're watching Morning Brief. There you're taking a live look at the opening bell at the New York Stock Exchange. Forbes ringing the opening bell there. And at the NASDAQ, you've got AWS startups ringing the opening bell, kicking off the trading action. Yeah, go ahead, press that button. Well, the funfetti doesn't necessarily correlate to the button one for one, but anyway, you saw it go off and you saw the button get pressed. So, hey, things are open here on the day. Let's take a look here at the major averages as we begin today's trading session. You've got gains across the board as of right now. We're taking a look at a move higher of 0.1% for the Dow, the S&P 500. That's up 0.2%. NASDAQ Composite, that's also up 0.2%. But let's take a look at one of the major components, the big mover here at the open. We're tracking Nvidia, and of course, not the largest mover right now. It's up 0.7%. But here's the move that we're talking about. The valuations of Nvidia, Microsoft, and Apple here. And if you take a look at this chart, here's where you could see Nvidia reclaiming its top spot, but they're still jousting neck and neck here in terms of Microsoft and Nvidia's market cap. However, we will see going forward from here how analysts continue to weigh in. You'll remember some of the commentary coming out of earnings as we were listening into Mizuho. Mizuho was talking about a lot of the concerns being behind us there. Their exact words within that saying the key risk factors and headwinds keeping many underweight on the stock have definitely lessened or lifted. Bernstein, they had said, takes a licking and keep on ticking. Wedbush and Dan Ives saying the godfather of AI delivers again. China H20 headwind, well known, still robust. So all of these things considered, we're now seeing even more of an appetite for investors out there who hadn't already piled back into Nvidia, now having the earnings in the rearview mirror and going forward seeing more total addressable market opportunity, potentially even in a market that they have to try and figure out what type of chip can actually get past some of the regulations and past the sniff tests as they are looking to ship into China. Oh yeah, and some major partnerships in the Middle East as well that Jensen Huang was able to net in recent weeks. We'll see how those come to fruition. But all that considered, the world's most valuable company, once again, Nvidia. We'll see how some jousting plays out over the course of today's trading session as well. Maddie?
Brad, thank you so much. It's time now for today's strategy session. For investors expecting rate cuts this year, you may have to wait longer than expected. Goldman Sachs expecting little moves on the rate front in 2025, with easing coming next year as the president's trade policies muddy the Fed's outlook. Traders are ramping up hedges against big shifts in the Fed's interest rate path, indicating they expect higher for longer rates. The chart here showing a contrarian wager that the Fed won't cut interest rates this year. Looking at futures contracts for the secured overnight financing rate, which closely tracks the rate that is set by the Fed. Joining us now on this, we've got George Bory. He is Allspring Global Investments Chief Investment Strategist for Fixed Income. It's great to have you here this morning, especially in the context of some of the labor market data that we have been getting in here. What does any signal of softening in the labor market mean for the Federal Reserve? It is bad news in the labor market, good news for folks who want to see rate cuts this year.
Yeah, hi, good morning, and thanks for having me on the show. But Madison, as you mentioned, we had some weaker than expected job data today out of ADP, showing kind of a deceleration in job growth, and that has been a consistent theme that we've been seeing kind of unfold over the course of this year. Jobs are important. They're important for the Fed. The Fed has really kind of coalesced around around expectations for the labor market. And if job growth is slowing or shows ongoing signs of slowdown, that provides sort of the opportunity, if you will, for the Fed to start cutting rates. As you point out, the market's not expecting much. Right now, the market's expecting 2 rate cuts between now and the end of the year. But we might see that start to change, particularly if the job market does slow. And on Friday, we have the payroll report. We'll see the market is still expecting payrolls to be up 130,000 last month. But we'll see what kind of numbers ultimately come out, as we know that can be a very volatile data series. So, we're kind of in wait and see mode, similar to the Fed. But the most recent data would suggest that the labor market is softening, at least on the margin.
George, what is the likelihood that, especially as companies are increasingly citing uncertainty because they don't know how some of the trade deals are going to net out, at what point do companies not only adjust how much they're looking to hire, but also say, okay, if we're not anticipating a deal, perhaps that becomes the new baseline, is that we don't anticipate a deal and that we actually do have some certain, like that, the uncertainty almost becomes the uncertainty in that frame of mind there.
No, you make a great point. Tariffs have been difficult to calibrate. Number one, it was a big surprise back in early April. We then had the tariff announcement extended. We're in the negotiation period, and now we're seeing sort of pushback from the judiciary side of government. So tariffs remain a meaningful question mark kind of hanging over the market. While we're in, again, kind of this wait and negotiate phase from the government's perspective, you're starting to see revenues flow into the government. That's a positive from the government's perspective of having more cash. But as you point out, for companies, it's difficult. It's difficult to determine how we're going to hire, how they're going to spend money and invest in capital, and how to make strategic decisions as it relates to acquisitions and mergers and sort of the build out of certain industries. So there's been a notable slowdown in some of that activity. What we are seeing, at least in the bond market, is that we're seeing an ongoing and a meaningful wave of refinancings as companies take advantage of what's a more calm environment right now in the bond market. Bond yields have come down a bit, and as I mentioned, that data is kind of putting some downward pressure on yields, upward pressure on price. That creates a window here for companies to shore up their balance sheets. We think that will continue to the extent volatility remains low, and companies want to get ahead of the unexpected, the known unexpected sort of scenario as it relates to tariffs, and we're going to have to wait and see.
How does the tax bill play into that dynamic you laid out so well in terms of company uncertainty? Does that provide any sort of Band-Aid to that wound?
I think potentially it does, but we have uncertainty there as well. I think on balance, the tax bill, at least as it was presented from the House, would on balance be pretty favorable to the corporate sector, we think, and we'll see what the Senate is likely to produce, but we see some really good things coming through as it relates to the expensing of capital spending and initiatives to encourage companies to invest in certain industries, certain places like energy. Those types of incentives should help corporations and could help them quite a bit. But similar to tariffs, we're still in wait and see. So we think we're in this environment where over the summer we're going to have to kind of wait for a little while. Like, again, thinking about what's happening here in the bond market, it's kind of steady as she goes as we wait for these outcomes. To the extent we get some of the things that are proposed, that should help corporations. It should help both the stock side and the bond side. But we have to wait to see what Congress ultimately delivers.
I want to switch gears ever so slightly and talk to you about foreign demand in the bond market. We've been talking about the risks of the deficit to the bond market so much, but I wonder too how you're thinking about risks of de-dollarization, of declines in the dollar that make it just too risky to own too much stock in terms of U.S. equities or too much of U.S. Treasuries.
It's a great point. And as a bond investor, we are global bond investors. We invest all around the world. We also have clients from all around the world. So we watch this very, very closely. And to date, we have not seen a meaningful shift away from the US. We watch the bond auctions on the Treasury side. We also look at the demand data that comes through on the corporate bond issuance side. And it would suggest that there's ongoing demand from non-US investors for US debt. And that gives us some confidence that should persist. There's still a lot of excess savings around the world. Much of that money has to be recycled, and much of that money ultimately goes into US dollar debt securities. There is obviously a longer term question mark on how long that will last. Are we reaching some sort of tipping point? Is there going to be a buyer strike from international investors buying US dollar denominated debt? We have not seen that yet, and we look at all sorts of different data that could suggest that. But so far, the demand has been fairly robust. Different points along the curve have different levels of interest, and we've seen the long end kind of show some weakness from a demand perspective. But as we move further down the curve, there's still very strong demand for both for U.S. government debt, for corporate debt, for mortgage-backed securities, and even for municipal debt, which is always, I find, kind of interesting. Non-U.S. buyers buying municipal debt, again, kind of ticked up. And I think it really goes to the heart of just a good, attractive yield, good, attractive nominal and real yields, and then very importantly, great diversification across the U.S. It's the deepest, broadest bond market in the world, and investors from all around the world still want to access that.
We got a Muni Mentions 10 minutes after the open here. George, thanks so much. We appreciate it.
Thank you. Have a great day.
You too. Let's get to the three market movers that you need to watch for the trading day. Yahoo Finance's Jared Blickery has more. Hey, Jared.
Thank you, Brad. We've been talking about Nvidia, the biggest stock in the solar system. Well, it has led to a tech breakout. So we're seeing that in the NASDAQ. We'll get to that in a second. Also covering some of the sector winners that we've had since that big April 8th bottom and rally since then. Tech up over 30%, leading the way. And finally, we will dig into some of the stocks that are hitting all-time highs. So let's dial up the Wi-Fi Interactive behind me, and we will start with the NASDAQ 100. And here's a candlestick chart. Each candlestick measures 1 day. This goes back 1 month, and we were stuck in this 3-week trading range. And over the last 2 days, today included, looks like we're at another high here. We have finally broken out, not by a large amount, but by enough to call it a breakout. And if we look at the S&P 500 today, we are also breaking out. And here's the year to date. And I'll put some lines on there. You can see we are only 3% or so off of those record highs that we had way back in February. And so just kind of advancing along those lines. Didn't have a real big catalyst, but nevertheless, the market moving higher. That's what we want to see. Also, this just caught my eye. All Country World Index, the rest of the world, and with the U.S. included, that has been hitting record highs for the last 3 days. So just seeing a lot of bullishness around the world. And then I'll close this sector with a look at Nvidia. And let's put the 1-year chart there. As we've been discussing, now reclaiming that top spot over Apple, Microsoft, biggest stock, and that is within spitting distance of its record high as well. So let's move on to the sector analysis. I'll show you what's going on today real briefly. Healthcare in the lead, along with communication services and tech and industrials. Those four up here are outperforming the S&P 500. Utilities, staples, real estate, consumer discretionary to the downside. Mostly defensive in there, not consumer discretionary. But here are the results since that bottom. And you can see XLK, that's the tech sector, up 32.1%. Following that, we have both industrials and consumer discretionary, each up more than 2%. All three of these outperforming the S&P 500, which itself is up 20%. And never fell into a bear market, by the way, so still in a bull market since October of 22. And pulling up the rear is healthcare. We have seen that just kind of get hit at day after day, especially United Health and some other big names. But if we take a look at some of the leaders here that we're looking at having all-time highs, and these percentages behind me are all year to date. Broadcom. Let's take a look at Broadcom on a 1 year, just completed a cup and handle, broke to its first record high of 2025. Guess what? So did Robinhood. In fact, this is the first all-time high it has reached since the early days in trading, going back 3 or 4 years. And you can see it is up a blistering almost 250% this year. And I also got to call out Cardinal Health, because I was just talking about some of the weakness in healthcare. Not this stock. Take a look at this. 1 year up 57%. That is a nice straight line. Even over that nasty bear market we had in 22, it was riding high. And so within even some of the beleaguered sectors, we are finding these pockets of strength. And I'll send it back to you, Maddie.
Jared, thank you so much. As always, great overview. Coming up here, we got the battle of the discount retailers, how Dollar Tree compares to Dollar General, and what the results signal about the health of consumers. That's next. Dollar Tree sinking after warning of a potential 50% profit drop year over year in the current quarter due to tariffs. Still, the discount retailer outperforming Wall Street's expectations in the first quarter. Brooke DePalma is here to break down the numbers. Brooke, that guidance here really being a sticking point for investors.
Yeah, certainly not what investors wanted to hear this morning, especially after the discount retailer really outperformed its peers this past quarter. If you take a closer look when it comes to revenue and adjusted earnings, you saw a beat on both the top and bottom line. But what exactly they warned towards that second quarter impact was that adjusted earnings will be down as much between 45 to 50% compared to a year ago. But they did say that it will reaccelerate in the third quarter and fourth quarter. But of course, this potential earnings impact from those higher tariffs is certainly what investors have been focusing on in terms of these first quarter results. The company, because of this, did update their adjusted diluted earnings outlook. They now expect it between the range of $5.15 to $5.65. That's compared to the previously projected $5 to $5.50.
So, Brooke, walk us through how Dollar Tree compares to its rival, Dollar General here.
Yeah, well, bottom line here, higher income audience or consumers are flocking to discount retailers. That's what we saw from both Dollar Tree and Dollar General. When you take a closer look at the numbers, same-store sales growth came from both discount retailers. We saw a 5.4% same-store sales growth for Dollar Tree this morning. Dollar General also seeing an uptick of 2.4%. And what really drove Dollar Tree same-store sales growth this past quarter is that foot traffic. We saw higher foot traffic, up 2.5%. The CEO even telling investors on the call this morning that it's gained 2.6 million new customers in the quarter, even highlighting Dollar Tree dinners on social media getting some buzz. We did see a slight decrease from Dollar General, but they said that they ended the quarter with higher foot traffic. And when it comes to ticket growth from Dollar Tree, we saw that increase upwards of almost 3% for both discount retailers. And what really drove momentum for Dollar Tree this past quarter is that multi-price strategy. That's really bringing in this middle and higher income audiences. They really try to navigate this environment and look for value where they can. And ultimately, what we saw here is that Dollar Tree's same-store sales growth even outpaced that of Walmart's U.S. same-store sales growth. And so that really keys into what we're seeing right now with the consumer. They want value, they want the best bang for their buck, and they're willing to search around to get it. So when you take a look at these numbers, Target certainly coming in down below Dollar Tree, or Dollar General rather, coming in below Walmart and Dollar Tree, but Dollar Tree is certainly a stand-up quarter when it comes to this same-store sales growth.
A lot to track within the retail landscape. Brooke, thanks so much. Well, retailers across the U.S. are taking different approaches to tariffs, with some raising prices for consumers and others choosing to eat the costs. Joining us now, we've got Mark Matthews, who's the National Retail Federation Executive Director of Research. Good to have you back on the program with us. How are you viewing the retail landscape right now and the pulse that you're hearing from some of the executives in the face of some of the uncertainty that they're citing when they report earnings?
Yeah, that's a great question. It's a really challenging environment right now. Just trying to understand what the consumer is doing and how the consumer is behaving. In January and February, we saw strong disposable income. We saw strong, consumer finances. But sentimentally, consumers have been weak. As we all know, sentiment is very low. And we definitely saw some fall off in spending in January and February. However, we saw the opposite in March and April, as we saw consumers pull purchases forward because they were worried about tariffs. And right now, I guess the big question for everybody is, what's going to happen next? Some of those pulled forward purchases represent lost future sales. And we still have a very uncertain consumer. So the challenge becomes understanding where they're headed. And right now, as we see, consumers are uncertain, they're concerned, and it looks like, we see a lot of trading down. Consumers are looking for value for their dollar.
Yeah, they certainly are, Mark, and it makes me wonder, too, which retailers are best positioned to win in that particular environment. What do you think is the winning strategy for retailers to navigate tariff policy?
Yeah, I think we saw something pretty similar in 2022 when we had high inflation. When the consumer is out there looking for the best price, you want to be a retailer that is offering the best price. You want your consumer to believe that they're getting value for their dollar. So I think that's the challenge for everybody. An uncertain consumer means that they're going to be much more careful with their money.
How close were some of these retailers to not having store shelves stocked going into the summer had we not seen some type of move lower in the tariff rates that countries were imposing on each other after the Liberation Day outset and then the subsequent kind of reversal?
Yes, it's a great question, and I think you almost have to look at it individually. Remember that retailers order, 6, 9, even 12 months in advance, and we know that a lot of retailers pulled purchases forward. So we saw a lot of heavy traffic, on ships coming in and, December, January, February. So I think a lot of retailers were preparing for this, were ready for this. But if your business model is all about having, the latest product available on your shelf, if you're a fast fashion retailer, it's much, much harder to shop, 9 months in advance. If you're selling groceries, again, you can't have grapes sitting on your shelf for 6 months. So you really do have to look at the retailer and what they're selling to understand where they stand.
In the absence of deals right now to be netted out, how will this dramatically shift the mindset for how supply chains and how sourcing of some of this inventory could dramatically change going forward and kind of reducing some of the reliance on both China but also in the Asia Pacific region?
Yeah, and again, we saw some of this, during the pandemic, right? There was a lot of shifting of sourcing. I think one of the challenges now, when you have, broad-based tariffs on a lot of different countries, it becomes much, much harder to source. So it is a real challenge for retailers. I don't expect that we're going to see, empty shelves anytime soon. I think that's an anathema for retailers. They ordered ahead. There will be stuff on the shelves. The real question is it the right stuff? Is it at the right price? And do they have the quantities of the things that people really want?
Mark, really appreciate it. Thanks so much.
My pleasure. Thank you.
All your markets action ahead. Stay tuned.